Hey everyone, welcome back to Corporate Decoder. Today we're diving into a behemoth of a filing, a report that is so packed with details it is like finding a hidden treasure chest in a spreadsheet. On the 7th of November 2025, the RBB Trust, a big player in the world of investment companies, dropped its annual shareholder report. This isn't your typical quarterly update, it's a deep dive into their financial health performance of their various exchange-traded funds, or ETFs, and the strategies behind them. Think of it as a yearly checkup for a bunch of investment businesses rolled into one. Some of these funds are brand new, just starting out in 2025, while others have been around for a while, giving us a chance to track their progress. Let's start with the Advent Convertible Bond ETF, or ACVT. This fund is all about convertible securities, which are like a blend of bonds and stocks. They offer a bit of both worlds, and for the period ending the 31st of August 2025, it looks like this ETF did pretty well, outperforming its main benchmark. Now, everyone loves to know about costs. For a hypothetical $10,000 investment in the Advent Convertible Bond ETF, the costs for the period were about $23, which is 0.65% of your investment. Pretty standard stuff, but remember this period was shorter than a full year since the fund only started in April 2025. The story here is interesting. The fund did better than a broad market index, the Bloomberg US Aggregate Index, and about the same as its specific convertible index, the ICE BofA Yield Alternative US Convertible Index. It started in a time of a lot of uncertainty, like about the economy and trade policies. But as those worries eased up, the market for convertibles actually got better, with company values going up. The fund was smart by having less exposure to bonds with longer maturities than the main index, which helped it avoid some of the downsides when interest rates started to climb. Looking at what helped the fund the most, we see names like Wayfair, Coinbase Global, Lumentum, and On Semiconductor. These companies likely saw their stock prices do really well, driving up the value of their convertible bonds. On the flip side, companies like PGI Corp, Travere Therapeutics, Dropbox, and Akamai Technologies dragged the performance down a bit. Perhaps these companies faced some challenges or their convertible bonds didn't keep pace with the broader market gains. As of the 31st of August 2025, the Advent Convertible Bond ETF had about $27.5 million in assets. It held 54 different investments, and its average credit quality was BBB-, which is considered the lower end of investment grade. The effective duration was 2.32 years, meaning it was sensitive to interest rate changes. The top 10 holdings show some big names you'd expect in a convertible bond fund, like big banks such as Wells Fargo and Company and Bank of America Corp. There are also tech names like Workiva Inc. and Shift4 Payments Incorporated, along with consumer discretionary companies like Penn Entertainment Incorporated and NCL Corp. Limited. Keeping the momentum going, let's look at the First Eagle Global Equity ETF, or FEDG. This fund focuses on global stocks. It is also quite new, starting in December 2024. For a hypothetical $10,000 investment, the costs were about $39, which is 0.50%. Again, this reflects only a partial year since its inception. This fund has had a strong start, returning a whopping 21.58% since its inception through August 2025, significantly outpacing the MSCI World Index, which grew about 14.17%. This outperformance is likely due to smart stock picking. The report highlights that consumer staples, industrials, and financial sectors were big contributors to performance, while healthcare and communication services were weaker spots. It seems like the fund did well in areas that offered more resilience. With 84 holdings, this fund manages nearly $500 million in assets. Its top sectors are consumer staples, industrials, healthcare, and financials. Now, let's check in on the Torre Equity Income Fund. This fund recently changed its name and its investment focus to emphasize income. The costs here are a bit higher at $100 or 1.00% for a $10,000 investment. This is on the higher side compared to many ETFs, but it might reflect active management or specialized strategy. This fund actually underperformed its benchmark, the MSCI EAFE Total Return Index, by a noticeable margin over the past year. It aims to combine global equities with active currency positions, and it seems like the currency strategy might have been a drag this period. Interestingly, a huge chunk of its assets, nearly 80%, is in US Treasury bills. This is a very conservative allocation, likely to provide stability and perhaps to fund its FX strategy. Moving on to the Penn Capital Short Duration High Income Fund. Ticker PSNX, this fund is designed for income. focusing on short duration, high yield bonds. For a $10,000 investment, the costs here are $56, which is 0.54%. That is quite reasonable for a high income fund. This fund actually did well, generating a 7.10% return, outperforming its benchmark, which returned 6.76%. Its strategy of avoiding the lowest quality CCC rated bonds seems to have paid off. The top holdings are dominated by corporate bonds, with One Main Finance Corp being a significant position. This makes sense for a high-income, short-duration bond fund. Finally, let's look at the Penn Capital Special Situations Small Cap Equity Fund, ticker PSCNX. This fund targets small companies with special situations, which often means looking for undervalued companies or those undergoing significant change. The costs here are a bit higher at $120 or 1.09% for a $10,000 investment. Small cap funds can sometimes have higher expenses due to the research involved. Despite the higher costs, this fund delivered a fantastic return of 20.34%, significantly outperforming its benchmark, the Bloomberg 2000 Index, which returned 8.20%. This is a really strong performance. The report points to technology, healthcare, and consumer discretionary sectors as key drivers of this success. Companies like Lumentum Holdings, Alphatech Holdings, and Sportradar Group AG were big contributors. Overall, considering all these funds and their reports for 2025, it is clear that the investment landscape has been dynamic. Some funds weathered market uncertainties better than others, and active management, particularly in the convertible bond and small cap segments, seems to have paid off. Costs remain a factor, but when performance is strong, investors might not mind paying a bit more for specialized expertise. It is a mixed bag. But the focus on income and specific situations shows managers are strategically navigating different market opportunities. What is your take on these fund reports? Do any of these strategies stand out to you? Drop your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate deep dives. And don't forget to join our Discord community, linked in the description, for even more insights and discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.